Anytime I see Alibaba being pumped up here on YouTube, it makes me shake my head just a little bit, because what these YouTubers will consistently talk about is its cheap valuation, the low forward price to earnings multiple, the low free cash flow multiple. They'll talk about the dividend. They'll talk about the extensive buybacks that this company has in place. And of course, they have to talk about the nearly 50% decline over the past 5 years. But what they fail to talk about is the fact that this company simply isn't what it once used to be. And look, that's okay. Companies change over time, and maybe Alibaba can get back to a point where it trades up to $200, $300 a share. But certainly over the past couple of years, couple of quarters, they simply haven't been good enough. And look, when you're not good enough, your stock price will reflect that, and you just have to come to terms with that. Hey guys, hope you're doing well out there. It's time to check in with Alibaba Group Holdings, ticker symbol BABA. We check this one out basically once every quarter. Over the past, call it 5 years, you saw it down nearly 50%. Year to date though, your performance hasn't been as bad, up just 3.5%. Keep in mind though, you're still not keeping up with the benchmarks. And actually that's something I would recommend. If you're thinking about investing in Alibaba, definitely watch this video all the way through, and then think about how you could instead put your money simply in an index fund and at least keep up with the markets over a long amount of time. Now, Q1 revenues, which Alibaba reported this morning, came in at $33.5 billion. That was good for just 4% revenue growth year over year. So look, your top line revenues not growing at a very fast pace. 4% growth, while it's not terrible, simply not that great. Now, what's even worse is your Q1 non-GAAP earnings per share came in at $2.26. While that was a beat on Wall Street, it was a decline of nearly 5% year over year. And look, while I wouldn't consider these beats or misses all too much, because you have just a couple of analysts on Wall Street, at least here on Seeking Alpha, making those targets. And so I wouldn't take those beats or misses really with any significant amount of weightage. But what I would consider is just 4% growth on your top lines simply isn't that great. Now, what's even more concerning is your free cash flows in this most recent quarter were down nearly 56% year over year. Guys, free cash flow is probably one of the best metrics to judge a company on. And when your free cash flow is down nearly 56% year over year, that is cause for concern. That is a reason why your stock should be down 12.5% over the past 1 year. Maybe why your stock should be down nearly 50% over the past 5 years. Now, it's quite simple why free cash flow is down 56% year over year, and that's because your operating cash flows came in down nearly 26% year over year. So when your operating cash flows are down nearly 26%, and then you're not able to control costs, as we'll see with this company, yeah, that's going to absolutely destroy your free cash flows, down 56%. Now, what's even more concerning, if that wasn't enough, is the competition in China simply continues to heat up, and there's other companies nipping at Alibaba's heels, ready to take their position. You have a company like JD.com posting record high net profit after their Q2. Now, you might be saying, look, this quarter isn't an Alibaba issue, it's an overall macro China economy issue. And look, to some extent you are correct, because JD.com's revenues only increased 1.2% year over year. So yeah, I could definitely give you credibility that, look, the entire Chinese economy is seeing a pullback, is seeing a slowdown, because your revenues over at JD.com up just 1.2%, your revenues at Alibaba up just 4%. But with that in mind, there is some cause to be concerned about over at Alibaba, because your profits over at JD.com are up nearly 74% year over year, where your profits at Alibaba were actually down on a year over year basis. So to some extent, yes, it is the overall Chinese economy that is seeing a slowdown. But I think to a far greater extent, you have concerns over at Alibaba, more specifically due to their high capex and high operating costs. And you'll see that when you get over to the different segments of this business. So the Taobao and Tmall group, this consists of their, I'd say, bread and butter, the largest retail commerce business within Greater China. That grew at just, in fact, that declined at right around 1%. So that gives you reason to be concerned. Your largest business unit over at Alibaba, nearly $15.6 billion US, declining 1% year over year. Now, you might be asking, how does that translate to the operating incomes for that business unit? And look, it translates nearly perfectly, as your operating incomes for the Taobao and Tmall group declined 1% year over year as well. And so look, keep in mind, this is your largest business unit by revenue, makes up nearly 50% of your total revenues. And then by far, it's also your most profitable business, as it makes nearly 50% margins, provides nearly $6.7 billion in operating income for this company. So keep in mind, your largest business, both from a revenue and operating income perspective, both declining 1% on the revenue and operating income side. That is not a good sign for this company. Now, moving on to their cloud group, this grew at just 6% year over year, up to $3.6 billion. Now, keep in mind, 6% growth on your cloud business, again, isn't great, especially when you're competing against the likes of Azure, which is growing nearly 30%, Google Cloud also growing close to 30%, and then AWS growing in the mid to high teens. So keep in mind, Alibaba Cloud, although they're fourth place in the market share overall, in terms of cloud service providers, just 6% growth year over year on that side, simply not that great. Now, what I want to point out though is the fact that 6% revenue growth on that business unit does translate quite nicely to the operating incomes, which grew at nearly 150% for the cloud intelligence group. So keep in mind, any small growth on the top line for that cloud business translates pretty substantially to the bottom line profitability for that business unit. Now, while that's great and all, what I do want to point out is they're eking out just minuscule amounts of operating profit. So nearly $300 million in operating profits off of $3.6 billion in top line revenue. So you're looking at margins less than 10% on the cloud side. And keep in mind, $300 million on a quarterly run rate, simply not moving the needle for a company that's still valued $190 billion. Look, if this company was growing that cloud business faster than 6%, then sure, we could maybe give them a bit more credit for that. But they're simply not growing it fast enough, and they're simply not generating enough margins on that business unit, at least yet, for us to give them credit for this cloud business unit, especially when you compare it to companies like Azure, companies like AWS that continue to out-invest Alibaba and see returns on those investments. Now, a bright spot is the international digital commerce group, that is basically Alibaba.com on the international side. That grew at nearly 32% on its top line, coming up to $4 billion. So keep in mind, that's still bigger than your cloud intelligence group, and certainly growing 32% isn't anything to scoff about, and that's pretty solid growth. Now, what I do want to point out is that business unit is just not profitable. You lost nearly $500 million running your international digital commerce group. What's even worse is the operating incomes went in the wrong direction by nearly 800%. Yeah, you grew your operating losses by nearly 800% in that side of the business. So this would be like running a lemonade stand, paying $4 to make a lemonade and then selling it at $1. Of course, you would grow your revenues very fast. Yeah, no doubt, you would absolutely grow your revenues at a very fast clip. But at the same time, you would not make $1 on it. In fact, you'd lose money at probably a faster and faster rate. And that's exactly what's happening on the digital e-commerce side on that international business. So keep in mind, while you're still growing your revenues, while this is what the Alibaba bulls over on YouTube will highlight, what they'll fail to talk about is the fact that the operating incomes on that side of the business continue to turn in the wrong direction. They've really never been profitable on this international e-commerce side of the business. On top of that, you have the logistics network, again, growing 16%, nothing to scoff about, but keep in mind, you're just basically on a break-even basis on that logistics group, also turning in the wrong direction, increasing your operating losses by nearly 30% year over year. And then you have your other business units simply not that big, where you're continuing to lose money. So you have your total overall revenues coming at $33.4 billion, up just 4% year over year, and your operating incomes coming in declining nearly 15% year over year at $5 billion. So this company, while they're growing their revenues just minusculely, they're not able to control those costs, and so they're losing operating leverage, declining in operating income. So this is what I really want to point out. When you see a company growing just 4% on the top line and declining nearly 15% on the operating side of the business, that's simply not a good look, something that's really not sustainable over a long period of time. And that's why you see free cash flows and operating cash flows down substantially year over year. Now, what the bulls on YouTube especially will point out is that the company is doing a really, really big buyback. And no doubt, they do have a huge buyback in place, and they have that for a long time. Now, first of all, that really hasn't done anything but just settle out the shares over the past couple of quarters. But what I want to point out is this company is doing that buyback from their balance sheet, not from the operating cash flows that they're generating, because we just saw this company is generating less in operating cash flows than they were a year ago. And simply, when we take a look at their balance sheet, while it's still great at the current time, looking at nearly $55 billion in cash and short-term investments, notice that it is down on a year-over-year basis. Your cash and cash equivalents went down from 250 down to 219, and then your short-term investments coming down from 262 to 176. So this company is doing that buyback, now paying that dividend, and they're doing it from out of pocket, from their cash balance sheet, simply because their operating cash flows aren't that great. In fact, their free cash flows aren't enough to cover a buyback and a dividend at that point. So while this company's balance sheet still looks okay for now, and they can continue to certainly pay out that dividend and do that buyback, if this company's operating cash flows certainly do not turn around, that buyback would have to be cut at one point down the road if this company can't turn around the business, both from a cost but also from a revenue growth perspective. Now, in terms of the stock chart, if you're looking to buy shares of Alibaba from a technical perspective, you actually probably have the best case, because we just saw fundamentally really no reason to step in here and buy shares of Alibaba. But what you had from a technical perspective is a bottoming out in these shares. So over the past, call it 2 years, 2.5 years, you have basically a long period of sideways consolidation between, I'd say, $70 all the way up to, call it $110. And as you've seen, that has sort of been narrowed down over the past couple of quarters, and you're making this wedging pattern where you're coming close to a decision point. As this consolidation pattern continues, at one point or another, Alibaba shares are going to decisively, I'd say, break to the upside, or they'll break to the downside, because I'd say this wedging pattern is showing us an indicator that the consolidation pattern over at Alibaba is going to eventually come to an end. Now, what you have is a level of resistance or level of support, however you want to call it, right here smack dab at $80 a share. So if you have a bullish outlook on this company and you're making a bull case, what you want to see is Alibaba break out of this $80 resistance line, break above this descending wedge line, and probably break pretty significantly higher up to $110, $115. You want to break out over your previous set of highs at $100. Now, keep in mind, at $110, $115, that's a pretty significant move, nearly 30%. And at that point, no doubt, you'll probably get a retest back to the downside at some point, probably close to $90. And if you are interested in picking up shares of Alibaba, that could be your signal that the consolidation and especially the downtrend over at this company is over, and you could maybe look to make an uptrend at that point. But certainly if you don't get that, if in fact you get the opposite, that this company simply can't hold this $80 level, and you break probably, I'd say, underneath $65 a share, you probably have a pretty good chance of retesting these $60 lows, if not breaking through them even further. Because as we see, this company over the next couple of years simply doesn't have a bright future. You're growing your earnings at just a minuscule 5% over the next year, and keep in mind that's including the buyback that this company has in place, and your revenue growth of 9% is what Wall Street anticipates. I just don't see how Alibaba really gets there outside of maybe a really strong Q4 holiday time period. But keep in mind, from a technical perspective, if you are bullish on this name, the consolidation certainly is in your favor. This is a level where Alibaba themselves have picked up a ton of their shares, and you have a meaningful level of support right here at this $80 level. So if you break higher, you probably want to set a stop loss pretty tight, I'd say close to $70, and then you're looking for upside back in the $100 to $110 range. While that isn't a terrible trade, it is still a risky one, because first of all, you still have this company being a Chinese company, so you have inherent geopolitical risks. You also are coming up to election season, and so that could affect how Chinese companies are viewed. On top of that, you have increasing competition, a tough Chinese economy, and this company continuing to slow in their growth rates and continue to accelerate those operating losses in some of their largest revenue business units. And so that's something to be concerned about. I think that's one of the reasons why that's probably not the most attractive risk reward trade. But certainly if you are interested, I would set a tight stop loss right here at $70, because you certainly don't want to break through this level of support and break underneath this wedge, because that could signal more downside for this name. That's something I've been saying for a long time now. You'll continually have people come on YouTube and tell you how cheap the stock is from a valuation perspective, but keep in mind, their results are really backing those up in the fact that your free cash flow is down more than 50% year to date, and you're continuing to bleed more on your operating basis as you operate this company. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.